You're watching Biz One-on-One with Randy Lennon.
Grant Powell is a lifelong entrepreneur. He's been involved in all kinds of businesses, import, export. He's been in the construction business, you name it. And now he's an independent mortgage broker, which may sound not that interesting, but it's actually fascinating. And today we're going to talk to Grant about the whole world of mortgages and for even teenagers and millennials. And he's going to share with us the top 3 tips on how kids can become financially secure. So welcome back.
Thank you.
It's nice to have you, Grant. And you're on to your second book.
Yes.
Congratulations on that.
Thanks.
We introduced you a few months ago, and you're working on this book. So this is Thinking Outside Your Bank. What is that all about?
Well, it's about, there's so many different lenders out there besides just going to your bank. And with the recent mortgage tightening regulations, it's further important to find out all your options before getting into a mortgage. So it's totally thinking outside your bank, but on a positive way, because in the media there's been a lot of negative sort of things of what you can't do.
Right.
When you're thinking outside your bank, you find out all the possibilities that you can do.
Never heard of it. Negative media. Never heard of that before, Grant. And so it's alive and well even in the world of finance. So,
Yes.
I mean, that's the gut-wrenching feeling that you have. You get turned down at the bank for a loan or worse still for a mortgage, because it's people's lifelong dream to own their own home. Is that
Yes.
still alive and well even in the world of people no longer working for the same company their whole life and building up their pension and so on and so forth? Can we still own our own home?
Well, yes, exactly. You can. It's about fine tuning what you have in your history. And for example, a client came to me. They'd gone through consumer proposal. They'd gone to their bank trying to get a mortgage. They were pre-approved, but then when it came time to get fully approved, they were turned down.
Now, when you say they went through a consumer proposal, some people might not know what you're talking
Yeah,
about.
so that's similar to bankruptcy, so a debt consolidation, and it's sort of a black mark on your credit. And a lot of institutions for getting loans look on that as there's no way they'll go down that road.
Yeah, that's the exit ramp
Yeah.
for you.
But
Yeah.
there are some that will. So, yeah, with these clients, they went through that process, got turned down to their bank. They loved this property that they were about to purchase, and the last minute, they got turned down. So it was such a heartbreaking experience.
No, you said they were pre-approved. So
Yeah, they were pre-approved.
So, like, I go to the bank, I get my pre-approval. So, but it's not really approved.
Yes, until you match that home with everything else you have, your credit, your income and everything, that's when you get the actual the full approval, right? So it sort of slipped through the underwriting of their institution's cracks, but then when it came time to get the approval, they red flagged it and they stopped the loan. So these guys came to me, we restructured everything. I got them with a lender that didn't mind that proposal in there as their previous history, and we packaged it up nice so that when they found the home that they wanted, they were able to get approved, and now they live in that home.
And that's what gives you, that lights you up, is helping people that it's not just a clear path to getting a mortgage.
Yes.
So as a mortgage broker, you get paid on the other side. So it doesn't actually cost your client anything.
Oh, exactly. Exactly. I get a finder's fee from the institution I place your mortgage with. So, it just depends on what type of term you're going with, all those sort of things for what I get paid. But it's truly a free service for clients.
I'm going to admit that I haven't met a mortgage broker before who thinks of himself as a real financial advisor and is so passionate about helping people with their finances. And I haven't met one before that's written 2 books. So this second book is focused on young people. So
Yes.
even teenagers should be thinking about getting a mortgage. Millennials, I get it. Don't all millennials just have their parents buy them a house?
Well, they wish, right? But yeah, no, it's so important for teens, as early as teens, to sort of understand the credit process. I've been involved with Teen Global Wealth, which is the same sort of thing, helping teens around the world with trying to narrow down what it takes to start getting those good habits of saving first before you spend, so on and so forth. So it starts early.
And when I'm 60 years old, so when I went to school, there was no such thing as, we didn't learn anything about how to handle our finances. It's my understanding now that they're starting to teach some financial wellness or financial understanding to young people. So that's a big part of what this book is about.
Yes, it's because of the fact that the financial world is always changing, so it's getting tougher and tougher. So in the schools, yeah, they can sort of start tapping in on that, but it's when rules keep changing, it's really tough for the schools to sort of teach that. So I feel it's my duty as an industry professional to give this information that's current so that the kids and the millennials and everybody else can sort of try to understand what is needed upon them to sort of get a mortgage, what's asked upon them to get a mortgage.
Because even as a teenager in junior high, high school, with a job, if you start to build up good spending, saving habits, get a credit card. Like as soon as you're able to get a credit card or even use your parents' credit card and get used to the whole process, it's all part of, you could come out of, I know my own son came out of school with a good solid credit rating that we helped him establish.
Yes, and that's very important. That's one of the tips is to, you can even have your child on as an authorized user on your credit card from as young as 10 years old. They can be an authorized user, yes. So they'll have their own code and they can go and make purchases, and then when you get your monthly statement, you can go through the statement and find out which things they bought, and then those kind of habits of seeing the monthly statement and then have your child give you the funds for those purchases they made. Or of course, if you're going to give one as a gift, right? To your child. But that kind of helps kids get used to sort of paying with credit, but then realizing they have to have the money available at the end of the month to pay for those expenses they put on the credit card.
And what about this big mysterious thing called your credit history or your credit ranking, your credit score? This is something that, I was well into my 20s before I even knew anything about. Today, there's commercials on television saying, go to this app, find out what your credit score is. That's a whole new world, but it's a very important thing to be aware of.
Yeah, it's an important thing to be aware of, but also consumers have to be aware of when there's only two major credit score companies in Canada, and that's Equifax and TransUnion. So if you go to those particular companies and find out your credit score, that's totally legit. The ones that you're going to other companies that are independent of those, there's a meaning behind why they're getting you maybe a free credit score and stuff like that. They're looking to get your business as well, to offer you loans as well, right? So if you truly want to stick with just learning your credit score, it's more to go to either Equifax or TransUnion to find that score.
Go direct to those two actual sources of your credit score. So let's get into it. The specific advice that you give to teenagers. By the way, when can you start establishing your credit score? You're saying when you're 10 years old?
Well, you can be an authorized user of a credit card, but you can't actually.
That's not
in Canada until you're 18.
Score. Okay, so at 18 is when you start building up, you start establishing your credit. So let's talk about someone getting into that age range. What's important for them to understand, and then as they get into the current millennials, I guess, are in their 20s and 30s. How's the world different for them?
Yeah, it's even more important because when you're the teenager, it's if you have those good habits starting and you make small purchases, knowing that you're going to pay off your card 100%, and having maybe $1,000 limit, but paying it down to zero every month, and then slowly build that up. The tough part is when you get out of high school and you either start a job or you go to school and you get student loans and you have more debt than you're actually making money. So that's even more important to sort of balance things. So many students get into school, they get so much debt, and then it's really tough. They get into a debt crunch in their late 20s because they're not making the money yet, and so they're trying to balance all these things. But if you're in tune with your parents, the more you can sort of work as a younger child, you can sort of have those conversations with your parents so that when you go through your 20s, you don't have to get into that where you're almost going into bankruptcy or like really bad credit situation. That because when you're looking at purchasing a home, we look 2 or 3 years back to see your credit history, right? So if your credit history is scarred, it's going to take a while to repair that. So if we can never get to the point where it's that scarred, that's the best, place to go, right?
So, and it is a challenge because it's pretty easy to access student loans. So,
Yes.
it's not like you really have to qualify, they're available to you, but you can build up a lot of student debt.
Yes.
And, getting your degree that maybe doesn't get you that high paying job. And you end up going into business for yourself and you're not establishing normal types of credit. So
Yes.
it's an issue.
Yeah, it's an issue, and that's why, like, if families can work together, and if, for a lot of my clients, the only way they can get into a home, that the millennials and such is, for a gift from parents, an inheritance, that kind of thing. So you want to sort of see maybe you need a little bit of that money inheritance before your credit gets to a bad state where you're paying high interest debt to credit card companies and spinning your wheels.
So we promised our viewers that you would give us the top 3 tips on how to help your teens move towards financial security.
Yeah, so the top 3 tips. First, teens need to realize how to save and understand saving before you understand spending. And
That's a tricky one. That's a tricky one. And it's
Yes.
not just teenagers, by the way.
Yes, exactly, but it starts then. So it's to get those habits where you're either
Paying
them
yourself first.
Yeah, paying
Yeah.
yourself first, and have those teens, whether they're doing chores or doing part-time work, making sure that they're making the money first and then using that credit card to pay it off at the end of the month. And then by showing the fact that these credit cards are earning points or they're earning cashbacks, all that kind of stuff. So credit and using credit and establishing credit can be really rewarding in that regards as well.
So teens towards financial independence, number 2.
And yeah, understanding the credit process. So it starts at an early age. So it's about paying that credit card off 100% every month. And with parents going with their teens and showing them, okay, if you don't pay that credit card off 100%, you only make the minimum payment. This is the interest you're throwing away, right, every month, right?
Right.
And it's going to compound, right? And it's not going to help your score as well. So it's going through that process and sitting them down every month and showing these are the bills that we have to pay. This is the money that's going out. This is the money that's coming in, and getting those habits early on.
Number 3.
The third thing is those discussions. They go from there on how to establish credit, but it's great if you can keep that going. I have so many clients that keep that going with their kids to saying, hey, I realize it's really tough out there. The real estate market is not going down. My plan is to actually help you with your first home, whether it's to go on as a co-applicant or give you a
Right.
gift towards your down payment. But the main thing is you want to see that inspiration from your kids that want to build their credit so they get good credit, obtain a good career and have that financial stability. And third thing is to show that they've been saving. They haven't been living outside of their means.
One last thing we'll end with is the concept that I may want to help my kid, my child that maybe just got married or he's getting together with someone to get into his first home, because the home ownership is a big part of building financial security.
Yes.
And guess what? I don't have that check available. I don't have that easily accessible funds to help with that down payment. Or maybe I go co-sign on their mortgage. I can maybe access working with a mortgage broker to take some money out of my own house.
Yes, and it's looking at the overall picture. Like, is this property that you're going to buy, is that investment property, or is it just simply to raise a family, or it's the first step. Yeah, there's all sorts of, by looking at the full picture, because sometimes, yeah, you might not want to cash in your long-term investments because for tax purposes, right? To give that gift to your child, and all of a sudden at the end of the year you've got a huge tax increase, right? So
Whereas
sometimes
if you borrow the money out of your own
It's-
equity in your house,
Yes.
could be a better way.
well, it's tax-free.
Really?
Yeah.
Absolutely, that's correct.
And then at the end of the day, if you were to stay in that home, then it's reduces probate expenses, all these other things as well, because you have less equity in the home.
Learned a lot today, Grant, and congratulations on both books, and thanks for coming for your second visit
Thanks.
on Biz One-on-One.
Thanks so much.
You're watching Biz One-on-One with Randy Lennon.